After financial conditions loosened at one of the fastest paces on record in January, they tightened somewhat heading into February amid a higher than anticipated US inflation print that caused a repricing of the federal funds curve throughout the year in terms of where the federal funds rate trajectory is going to go. Also, because of this, we saw equities and bonds fall over the month. The upside surprise to US economic data over the month, including retail sales, non-farm payroll employment, as well as services PMI data, and most importantly, all the slew of inflation data for the releases of January, such as CPI, PPI, and PCE data, all surprised to the upside. And we believe that that may well result in the federal funds curve repricing even higher, as well as the dot plot in terms of the next Federal Open Market Committee being repriced higher. So we do believe in the message of the Fed needing to keep rates higher for longer to really quell the inflation trajectory to get it back toward 2%. Accordingly, we believe this update will be given at the next FOMC meeting, and that hawkish rhetoric will need to come back to the market, especially given the fact that financial conditions have loosened more recently, and we believe that it will need to be restrictive in order to get inflation back toward 2%. We saw Chinese money supply surprise to the upside over the month, coming at 12.6% year-on-year for the January release, compared to Bloomberg expectations of 11.7%. We've also seen recent upside surprises to economic data releases such as the manufacturing and non-manufacturing PMI releases in China. Accordingly, we believe that a sustainable reopening will continue. However, over the month of February, we did see a retracement in Chinese and Hong Kong stocks over the month. We ascribe that to renewed tensions between China and the US and causing investor jitters on the back of that from a flow perspective. However, at this juncture, we believe that the economy will continue to improve, and that is largely noise at this stage, and that we think that the fundamentals are continuing to improve. What we've seen so far is quite heavy accommodative monetary policy, particularly in terms of the liquidity injections that have taken place more recently at a very low inflation backdrop in China. In fact, we've seen that the latest CPI print come in at just 2.1% year on year, which will allow scope for further monetary policy easing to take place. So where to from here? We remain of the belief that the consumer demand will need to taper going into the future to keep inflation toward 2%. Accordingly, we believe that tighter monetary policy actions, particularly in the developed market world, will need to take place. We also believe that consumers will need to rein in their expenditure from a discretionary related perspective in particular, to tighten their income statements so that demand will be a lot lower going in the future, as we believe that is necessary for that to take place for inflation to get toward 2%. At the same time, we believe that financial conditions will need to be tighter for this to occur. Hence our view that earnings expectations from a company perspective in the developed market stage are still too optimistic, and that valuations remain expensive, particularly in the United States, from an investment point of view. Accordingly, we believe that these will still need to come down, and financial conditions will need to be tighter for the inflation trajectory to be at more sustainable levels going forward.